watching the latest news from FinancialMirror.tv. World stocks and the euro rallied on Thursday, boosted by sweeping gains in emerging markets after the U.S. Federal Reserve cut interest rates and opened swap lines to four developing economies. The Fed slashed half a point off the Fed funds and left the door open to further cuts, renewing weakness in the dollar but improving risk appetite as carry trade favorite yen softened. Japan and Germany also said they would plow billions of dollars into their economies, hoping to provide a cushion against a deep recession and complement a series of expected interest rate cuts. Germany's package will include support for car makers and building renovation, as well as tax breaks enabling companies to write off a share of their investments. Emerging equities that have bounced by nearly 22% from four-year lows set this week got a further boost from the IMF's pledge for short-term financing for economies that have a good track record but are having difficulties accessing credit. The Fed also opened up dollar liquidity aid beyond traditional markets with four new $30 billion currency swap lines with Brazil, Mexico, South Korea, and Singapore. With U.S. third quarter growth figures coming in, economists expect a decline for GDP of 0.5%, which many see as the start of a 9-month contraction, or possibly even longer. Asian equity markets surged, with Japan's Nikkei average up 10%. But analysts cautioned that investors had taken the chance to go bargain hunting and markets remained volatile. Britain's leading share index climbed more than 2% on Thursday as interest rate cuts boosted investor sentiment, lifting commodity prices and pushing banks and mining stocks higher, following the Fed's half-point rate cut on Wednesday night. However, the benchmark FTSE 100 that saw sharp gains on Wednesday is still down 13% in October. Miners were up as metal prices stayed above multi-year lows seen in October, and energy stocks continued in negative territory despite higher profits and oil rising to $68 a barrel, as investors worried about the outlook for demand. Banks benefited from the U.S. Federal Reserve's move to cut interest rates to 1% to increase liquidity in the market and cushion the impact of a global recession. But underlying fears about global recession remain, with the U.S. economy shrinking at 0.3% annual rate in the third quarter, its sharpest contraction in 3 years as consumers cut spending and businesses reduced investment. China, Norway, Taiwan, and Hong Kong also cut rates, paving the way for the Bank of England and the European Central Bank to ease policy at their regular meetings next week, and pressure mounts on the Bank of Japan to reduce rates after it meets on Friday. The Bank of England is expected to cut interest rates by 50 basis points next week, and possibly more as it tries to energize an economy that appears to have rapidly fallen into recession, according to a Reuters poll. All 62 economists in the poll said the BOE's Monetary Policy Committee would cut rates to at least 4% when it meets next week, to the lowest level since early 2004, with some forecasting a 3/4 or full percentage point cut. The BOE has never cut UK rates by more than a half point in recent years. It last cut them by a half a point to 4.5% in an unprecedented coordinated move with other world central banks earlier in October. Data released last Friday showed the British economy shrank 0.5% on a quarterly basis in the last 3 months, the first decline in 16 years after stagnating in the second quarter. The UK is now officially in recession, with both the stock market and the pound tumbling to multi-year lows recently on fears that the recession may be deeper and longer than previously expected. British property prices, a bedrock of consumer wealth, are seen falling 15% this year and a further 10% in 2009, according to another Reuters poll. The euro rallied sharply higher to levels close to 1.33 against the dollar as sentiment improved following the 50 base point rate reduction by the Fed and the Norges Bank in Norway and the 27 basis point cut by China, as the Bank of Japan, the ECB, and Bank of England are also expected to follow. The euro failed to show reaction to the latest batch of Eurozone confidence data, which show economic sentiment at a record low of 80.4, 5 points below expectations. Consumer confidence and the business climate also disappointed at -6 and -1.34 respectively. The euro is now seen targeting a 1.3480 against the dollar, according to BNP Paribas strategists, after which they expect the long-term decline of the single currency to resume. They also note that if the dollar breaks above 100.70 against the yen, there could be a near-term move towards 102.50. However, BNP Paribas do not expect this to be the start of a new trend. While the panic has subsided, global economic fundamentals will remain weak as lending is constrained. Furthermore, institutional investors are unlikely to switch to long risk positions given that hedge funds and other institutions are facing redemptions that require asset selling. Sterling, meanwhile, rallied furiously to 1.6675 against the dollar, despite calls for sharply lower rates from MPC dub David Blanchflower and Chancellor Alistair Darling signaling to the Bank of England that he would welcome lower rates. Saudi Arabia joined Kuwait and Bahrain in lowering interest rates to ease credit conditions and underpin their banking systems on Thursday, while the United Arab Emirates made a shock decision for the first time not to match a U.S. interest rate cut. Saudi Arabia's 100 basis point cut to 4% marks the second reduction of its benchmark repurchase rate this month, which was the first time in 4 years, as easing inflationary pressures and expectations made the cut possible. Economists at HSBC affiliate Saab Bank said the central bank's primary intention is to lower the cost of funding, which is the greatest concern for the private sector. The Gulf has massive infrastructure projects underway designed to diversify its economy away from relying on oil export revenues. Many of these projects are public-private partnerships, but private investors are finding it difficult during the global credit crunch to access abundant and cheap funds. The latest round of Gulf rate cuts was aimed at defrosting frozen interbank lending rates, but the UAE decided it was not a useful tool and opted to stay on the sidelines. Qatar, which sat out the last round of rate cuts earlier in October, also did not move interest rates immediately. Thank you for watching FinancialMirror.tv.